Hi, my name is Aaron Townsend, and here are my 5 tips on how to level up and build your business more effectively. Develop a business plan. A lot of people ask me whether or not they should waste their time writing a business plan. Personally, I think it's a bit outdated at the moment, and I think you should consider what we call a lean canvas. You can go on Google and search lean canvas, and basically what comes up is a number of boxes with a number of questions that you need to answer, essentially to work out whether your business is going to make any money or not. The first question you should consider is, what problem are you trying to solve? What problem are you trying to address in the market that you think people have an issue with? You should be able to come up with at least 3 different problems that your business is trying to address. For example, let's look at Amazon. When Amazon first started, they wanted to create the world's first online bookstore. But they knew that there was an issue. There was no cheap way to buy books online and for it to be able to deliver it quickly and effectively in a time span that people needed. So what you need to do is think about 3 different problems at least that your business addresses and that people actually think they have a problem with. Then, for each problem, you should come up with a different solution for each one. This way you know that there is actually a market and people might probably want to pay for the problem that you're trying to solve. The next thing you should think about is, what is your USP or your unique value proposition? What is it about you or your business that makes you special or makes your business special that no one else can do it? Again, if we go back to the Amazon example, one of Amazon's core values and core principles is customer obsession. They are absolutely obsessed with making sure that the customer is not only happy, but everything about them, whether it's a faulty product or whether there's a complaint, that they are completely satisfied. In fact, it's said that Jeff Bezos actually still gets emails to his own inbox about all of the feedback that Amazon gets. That is something that the business has developed and invested in from top to bottom. So think about what makes you you, what makes your business you. Certainly, by no means least, is one of the 2 most important boxes in the lean canvas is revenues and costs, or sales and cost. You need to work out how you're going to charge people for your services or for how much you're going to charge people for your products, and what's the cost going to be. That way you're able to work out whether or not it's actually profitable on a monetary basis. The power of a team. Go alone, go fast, or go far, go together. A lot of people feel that when they start a business that they need to do it by themselves. But actually, one of your key powers is actually being able to develop a fantastic team. So let's take YouTube as an example, which is the 2nd most visited site in the world today, with over 1 billion hits a month. It was started in 2005 by 3 guys, one named Jawed, one named Steve, and one named Chad. They all interestingly met at PayPal, which is another huge business that we all know and love. Chad was a designer, Steve was an engineer, and Jarrett was an advisor who could do both. So YouTube started in 2005, and they received their first investment in February 2005 for about $11.2 million. By September 2005, one of their videos racked up over 1 million views, which was Ronaldinho receiving golden boots from Nike, if you're old enough to remember. Then by October 2006, Google bought them for $1.65 billion. At the time, they only had a team of about 65 people. And what that shows is that all 3 of them were able to bring something different to the table. But more importantly, they all realized what their circle, or what I like to call their circle of competence, or what they're good at and what they're not. And as a business owner, you have to work out, what is your circle of competence? Once you've figured that out, what your circle of competence is, anything outside of your circle of competence, you want to hire for. So for example, maybe you're good at vision and long-term planning and vision planning, but you're absolutely terrible at details. that means you should probably hire a head of operations because that person is going to implement what you're envisioning. Each person brings different things to the table, and it doesn't mean that just because you're unable to do everything that you're not going to be in control. Building a great team, building a competent team is something that's going to set your business on fire and hopefully one day sell for over $1 billion, just like YouTube. Do you know how much money your business is making? Or unit economics? Being able to understand and know all of this type of sales and costs that run for your business is absolutely essential. And as a business leader, you're going to have to know every single number around your business. If you don't, you're extremely unlikely to be successful in business and very unlikely for anyone to actually give you any investment, whether it be a bank loan, venture capital, or startup funding. So, for example, what is unit economics? Unit economics is simply a way to understand how much money you're making on a per unit basis, or on a per product basis, or if you're a service business, on a per customer basis. So let's imagine that you have an online t-shirt store. For example, it's on Instagram. You're able to sell your t-shirts for £35. It actually costs you £10 to make the t-shirt, £2 to ship it, and £3 to package it. So your total costs are £15. So it means now that you've made a £20 profit. Happy days, amazing. But because it's on Instagram or because you have an online store, you actually need people to actually come to your store. You actually need to entice them. So let's assume then that for every t-shirt that you sell, you have to pay £5 of marketing costs. So now your profit has just been reduced to £15. And that essentially is what is unit economics. It's being able to determine on each product, customer, or service how much profit or loss you're making on each item. Now, there are some businesses, however, where on a per unit basis, you can make a loss because maybe the assumption is that on scale or as they sell more, they're able to turn that into more of a profit. But it's generally assumed that if on a per unit or a per customer basis, you're not making any money, it's probably not a good idea for you to get into that type of business unless you're able to use those customers and sell them other things. So that is what unit economics is. Do you know how much cash is flowing through your business? i.e. cash is still king. So just because you make sales of say £10,000, it doesn't mean £10,000 is going to be in your bank account straight away. Or say for example you have costs of £2,000, it doesn't mean that £2,000 is going to come out of your bank account immediately. So what I'm trying to say is that you need to understand the relationship between your balance sheet, your assets and your liabilities, your profit and loss, your sales and your costs, and your cash flow, and how it all interrelates. Because without cash, your business dies. And as long as your business is continuously generating cash, it still has a fighting chance to become a success. But if you continually lose cash and without investment, then you're definitely on the road, unfortunately, to death. So let's say in the month of February, I did £120,000 worth of sales. I got £30,000 worth of costs, which is on 30-day credit. I've got £10,000 worth of salary costs, of which £4,000 is income tax. So on my P&L, on what I'll show my profit and loss, is that I have £120,000, take away 30, take away 10, which is £80,000 profit, which is amazing. You probably assume then that I would have £80,000 in my bank account at the end of February. But that's not necessarily how cash works. Of my sales of £120,000, £60,000 was on 30-day credit, meaning that money is only going to come in March. So actually, I've only taken £60,000 in my bank account. £30,000 of costs is actually on 30-day credit. Again, that's going to come out in March. So I'm still left with £60,000 in my bank account. Of my salaries, if you remember, I said 4K of that is national insurance or taxes. Again, we've got a month to pay that, so that's going to come out next month as well. So what it means is then it's actually £60,000, take away £6,000, which is my net salary cost, which leaves me £54,000 in my bank account. So as you can see from the example, it can get a bit confusing or a bit complicated. And this is why people do detailed cash flow analysis or tracking what's coming in and out of their account, sometimes on a daily, a weekly, but as a minimum on a monthly basis. If you're able to determine and know when cash is coming in and out of your business, you're way more likely to know whether or not you're doing well or you're doing poorly, or whether you need to up your game in certain areas.
Aaron Townsend, level up, tip number 5.
The tax man always gets paid, or know the different taxes for your business. Even though I'm an accountant, I absolutely hate tax. But if you're going to be a good business owner, or if I'm going to be a good business leader, I absolutely have to have a general understanding of the different types of taxes that's going to affect my business. Normally, the most common form of taxes that we have to deal with is business tax or corporation tax, VAT, or income tax, such as national insurance, PAYE, and pension costs. Having a general understanding of these taxes and how they work and when they're due is going to be absolutely essential to making sure that you don't trip up when it comes to the taxman, because they always like to get paid. So, for example, let's say that your business is doing very well and you've made over £85,000 for the year. This is when VAT is going to start coming into play. So normally the rule is that if you've made sales of over £85,000, or you know that within the next 30 days you're going to make sales of over £85,000, you have to register for VAT, which means then that your sales now has just increased by 20%. So as a business owner, you have to decide whether you're going to drop your prices or whether you're going to take a hit on the margin, so in order to make sure that you keep your customers. Although you're having to charge VAT on your sales now, there is some light in the darkness, because what it means is that you are able to now reclaim the VAT that you're paying on your costs. So what that means is that when it comes to doing what's called a VAT return, or essentially trying to work out whether you owe the taxman money or what the taxman owes you, is basically the difference between the amount of VAT on your sales and the amount of VAT on your costs. And sometimes you're going to get paid by the taxman, which is great. Sometimes they're going to take some money off you and you're going to have to pay the VAT man as well. But having good VAT advice is definitely going to save you some heartache and pain. One tip, however, is that what I like to tell people is that you should set up a separate VAT account. Meaning every time you make a sale and there's VAT on that sale, put that 20% in a separate account. Even if you know at the end of the quarter you're going to get some money back. Because what it means is that you're not using that 20% of your sales for normal business or normal business workings. Because what can happen is that when it comes to paying your VAT, if you have to pay some VAT over to the taxman, you might not have the money there, and then you might start incurring interest and charges. And as I said, the taxman always gets paid. The next tax is to do with salary costs. So whenever you're paying salaries to yourself or salaries to your employees, there's going to be income tax, national insurance, and pension costs, which technically isn't a tax, but you have to now pay, you have to now sign up your employees to a pension. So with salaries and the taxes that are included in salaries, what normally happens is that you pay the net salary within the month. For example, if I'm due some salary in February, I pay it within the month. But my national insurance, my income tax, and my pension costs is normally due 30 days after. So one of the things to remember then is that money, those taxes, the national insurance, your income tax, and your pension costs, just to remember to pull it to one side, or to mark it, or to carve it out, or just to put a marker not to spend that money. Again, because what happens is that sometimes we forget that we have to pay our income tax or national insurance or our pension costs. And when it comes around to paying it, we're going to be in arrears, and we might have to start paying interest or renegotiate or negotiate with the taxman being able to pay it on time. So the last tax that a business will normally have to face is corporation tax or business tax. And that's normally only paid on your profits. So say, for example, you had sales of £120,000 and costs of £80,000, you've made a profit of £40,000. And so you'd only pay tax on that profit, on that £40,000. At the moment, the tax rate is about 19%. Also, you only pay, that tax is only due 9 months after your year end. So, say for example, your year end, your business started in January, your year end is 12 months after that, so December. So meaning your tax is not due until September the following year. Also, what's good about taxes is that you are able to offset certain costs and you're able to get certain reliefs as well. So actually you might not have to pay the full 19% depending on the size of your business, whether you have assets or whether you're a small business and you're making certain tech products as well. So getting good tax advice for your business on the taxes that I've just mentioned will definitely help you save money and hopefully ensure that you pay as little tax as possible.